Hello friends, today we are going to talk about debt reconsolidation. So when somebody says I don't have money, what would you do? When the client says I don't have money, you can't do anything. And that's sometimes it's not a real objection, many times it is a real objection. So always people will say no money because that's a good way to put you off. But generally they might be having some serious issues about their money. And my dear friends, what we need to do is we need to find the money for them. Yes, I am very clear about it. We need to find the money for them. Where is the money? Honey, it's there. Now one of the questions that I always ask people is, are you working for the bank or are you working for the family? My dear friends, it's a very serious question. Because many people are working for the bank instead of working for their family. Just because they don't do debt reconciliation. Because they don't do debt reconciliation. So debt means loans. Say they don't reconsolidate their loans or their investments. If we are able to do this very clearly and tell people, show them how they can find money within the money that they are having, and my dear friends, many of you also agents and development officers, many of you have also over leveraged your positions. Today it's so very easy to get loans. At a click of a button you get 5 lakh, 10 lakhs, there's a lot of offers which come, and many people fall a prey to that, and then they get this, they take this loan. They don't know how to calculate the real interest which is charged by the bank, because the bank will camouflage it in such a way. They will talk about reducing balance. They will never talk about reducing balance interest. They will only talk about flat interest. My dear friends, flat interest is a joke. When people talk about flat interest, you should always ask them, what is the reducing rate of interest, monthly reducing basis? Then you will get the real interest that you are paying. In our classes, we actually teach people how to calculate this so that they can help their clients come to a better understanding of managing their debt. Today's world, we are not just supposed to help people, or sell people life insurance. We are supposed to help people manage their finances more better. What is difference between you and the online platforms like Policy Bazaar and other places where people go to buy insurance? The difference is you have to contribute to their life. If you are not contributing to their life to make their life much more better, then you will not be the preferred option for buying life insurance. If you are just selling insurance, it's like the Policy Bazaar, it's like any other platform. But if you have to contribute to clients' lives, you need to have these distinctions. Another very interesting and important thing is that many of our agents are also working for the bank. They are not working for their family, and I will tell you how. So today's video will not only help you to take care of the no money objection, but it will help you also to manage your finances more better. Please download the FN calculator from the Play Store, and you will actually understand what is the kind of interest that is being charged. Also, there are a lot of institutes which are actually asking agents to over leverage themselves and take loans, because the more the loans, more the expense, or more the EMI, the better you will work, because there will be fire on your backside. Nothing more can be the truth. The minute you over leverage, when I was doing my MBA in finance, the minute you over leverage, the minute you go into more debt, you are moving towards bankruptcy. Please understand that very clearly. Income is never guaranteed. Income is never fixed. Expense and your EMI is fixed and you have to pay it. With that background, let us start. How do I help my client really understand his finances in a much more better way? Suppose if we go to a customer and you find that so many people including our dear friend agents are also doing that. What are they doing? they are using credit card to roll over the payments. Which means when you get a credit card bill, you don't pay the full amount. You just pay the minimum amount and then roll over that. It's called a revolving credit. When you roll over that credit, please understand, the bank almost charges you 40% interest. So on a 1 lakh rupees, you are paying 40,000 per year. And that's called a debt trap. And many clients also do that because it's very easily available. You don't have to actually apply and all that. You just don't pay your bill. You just pay the minimum. But my dear friends, there are two very important issues here as far as credit card is concerned. One is that the minute you pay the minimum, your CIBIL rating goes for a hit. It takes a toss and it goes down. So your chances of getting loan from bank gets reduced dramatically. Please understand, please remember this very carefully. It looks like a nice game, but it is not. So on one hand, you are paying 40% interest, 36 to 40% interest. On the other hand, you are losing your CIBIL rating, which actually is, the more stronger the CIBIL rating, the more better is your chance of getting a loan. So number one, never get into this trap, because it looks easy, but it's very, very difficult. Now I'll give you an example. So suppose if there is a customer who is actually, he has taken maybe revolving credit of around 10 lakhs. It may not be the case, but multiple cards many people have, and each card 2 lakh, 1 lakh, they just do revolving. So suppose if his total card revolving is around say 10 lakhs, approximately he is paying 40% interest on that, which means 4 lakh rupees per year he is paying as interest. Now what happens is, if you look at all his other loans, there will be a lot of loans. He'll have car loan, he'll have house loan, he'll have credit card loan and various others. Now if you look at his house loan, it may be at say 8%. But also you have to look at that if the house is costing say 50-60 lakhs and if the loan is just 40 lakhs, he can still take another 10 lakh as a top-up loan on his own house. Now this is the idea that I give to my clients. We apply for a top-up loan, we take a top-up loan. It can be around 8% approximately. Today you get anything at around 8%. On a 10 lakh loan, you have to pay just 80,000 rupees per year as interest. Now if you look at the comparison between both these, on the credit card you are paying a 4 lakh rupees interest. On the top-up loan you are paying only an 80,000 interest. So what I do is very simple. I ask the customer to take a loan, a top-up loan on his house. He gets 10 lakh rupees. What he does is, he starts paying 80,000 to the company from where he took the loan. It may be more based on EMI, but I am saying approximately the interest that he will be paying is 80,000 in the first year. And then what he does is, he takes that 10 lakhs and repays his credit card loan, and immediately his 4 lakh rupees is saved. So 4 lakh rupees is saved, and out of that 4 lakh saved, what is this 4 lakh? It is a 40% interest on the 10 lakh loan. This 4 lakh is saved, but he has to pay 80,000 to the top-up company, and therefore he saves 3 lakh 20,000. Now it's very easy for me to take the form, take a pen and ask him to sign and tell him to invest that 320, because this 320 was going for the bank. Now this 320 which is there will come for his for his family, and that is what is very, very important. Now the next thing that we need to do is very, very important, and that is, if we are going to take a loan, then we better be careful not to take a credit card loan. So this is the first option that you have to do. So what is this option? You find out the different loans that he is having, you find out what are the interest rates, and then try to get him a loan at a lower rate of interest. Find out where the opportunities to get a lower rate of interest loan, and let him repay the higher interest loan. Automatically some money will be created without him having to do anything. Very interesting example. The second example we'll take is, there are a lot of people, you'll find also they have a lot of, like they have, I just did one I was just doing this analysis for one customer a few months back. I found that he had an FD of 40 lakhs. Now this FD of 40 lakh was giving him a 5% interest. So 5% interest means on this FD of 40 lakh, he was getting a 2 lakh interest per year. But he was paying a 20% tax. Now please remember this. People are not, people don't know about this. They just see the earning. But he was paying a 20% tax. He doesn't know, but the chartered accountant obviously at the end of the year will include this 2 lakh in his income, and he will pay 40,000 as actual interest, which means actual tax, sorry, he will pay 40,000 tax. So he got 2 lakhs interest out of that 40 lakh FD, but out of that he paid 40,000 tax. So his net earning is 1,60,000. Also please remember, this earning doesn't come to him because normally people have cumulative FDs. So he has to pay this 40,000 from his pocket. That is one part. But when I looked at his loan, I found that he also has a loan at 12%, 40 lakh loan at 12%. Now if he is having another loan at 40%, at 12%, 40 lakhs at 12%, he is actually paying 4,80,000 per year. He is paying an interest of 4,80,000 per year. Now imagine that there is this interest is there will be EMI, that is, I am not getting into that, but imagine even if 3,60,000 interest, he gets a deduction for that, because obviously if it is not a housing loan, on a housing loan you just get 2 lakhs, but if it's a business loan you get about 20%, which means 72,000 rupees he will save as tax. So although he is saving as tax, so in the loan he is basically giving out 4,80,000 and he is getting a 3,60,000 deduction, which means 72,000 interest is what he is saving. Okay, and then if you take this particular, and that is where total about 1,60,000 is earning, but he is actually paying 72,000 if he saves, he is actually getting around 4,80,000, which is going out of his pocket. So if you take 4,80,000 and you take 1,60,000, okay, so 3,20,000 again is what he is saving from interest. Now just imagine this 3,20,000, what he is saving as interest is basically free money. It has been created because of your advice. Many people want to keep an FD. Maybe what I told this gentleman is you can keep about 6 months of your requirement is FD, and the rest please break it, repay the loan, so that you have cash flow within your investments and your loan. So this is called as debt reconciliation, where you take a loan at lower interest and repay loan at higher interest, or you take you liquidate an investment which is giving you lower return, and then also you repay the loan which you are paying at a higher interest. And if you see with this, 3,20,000 every year gets saved. The man or the family, you can tell him that now this 3,20,000 so far was going as income to the bank. Now this 3,20,000 from now on will come as an income to you. And since I have created this income, so I give him the form, I give the pen, and I say, let's start some investment planning or goal planning. And this 3,20,000 can be invested so that your family can live happily ever after. This is a wonderful way of creating money for the family. Are you working for the bank or are you working for your family? Before meeting me, he was working for the bank. After meeting me, he is now started working for the family. And this is the way, if you go, you will find many clients, they have no clue that these things can be done. Please create money for the client before you sell him life insurance. Thank you.